Hello everybody and welcome to Project Trade. This is the Technical Indicators Show, and in this video we are talking about the Stochastic Oscillator. The Stochastic Oscillator was gifted to the universe alongside gold and frankincense by George Lane in the late 1950s. Despite being a bit of an older indicator, it surprisingly managed to endure as a popular indicator amongst traders. It's a momentum-based oscillator which has two lines. Those lines then oscillate within a fixed range of 0 to 100. So if the stochastic has a reading of 0 as the lowest possible reading, it has to mean that a lot of selling has been occurring in the market. And if it was all the way up at 100, it's a lock that the market has been on the up because of the buyers. Every other figure is in between, with of course 50 being the central point. The stochastic oscillator traditionally uses its momentum to try and identify overbought and oversold signals on an asset, although I will say modern traders do have very mixed feelings at best as to how effective the indicator is in that role. Only you can decide that, so first let's get under the hood and check out the formula. As the stochastic has two lines, we've got two formulas to cover, so let's begin with the main line, which is the superbly named percentage K line. The formula for the percentage K is the current closing price minus the lowest price of the look-back period, which by default is 14 periods. Then that figure is divided by the highest price of the look-back period minus the lowest price from the look-back period. So essentially it is trying to compare the current closing price with low and high prices from that look-back. To then put it into its fixed range-bound oscillator, you multiply your figure by 100. That gives you your percentage K value, which you can then plot onto the oscillator, or maybe your platform does it for you. Now we've calculated the more difficult of our two lines, which hopefully it wasn't that complicated. Our second line is the percentage D line, which by default is a 3-period simple moving average of the percentage K line. It's trying to help smooth out that data for you, and as a moving average of the percentage K line, the percentage D line will inherently be the slower of the two lines. After all that, this is what it comes out looking like. The light sea green colored line being our percentage K line, aka the main line. Then our percentage D signal line is in red, and we've just marked out the default 80 and 20 levels on there. Those levels were the George Lane special source of defining the overbought and oversold territory on the stochastic. Depending on your platform, you may get an array of settings to choose from, so we'll just go through some of them here. Firstly, we of course have the amount of periods you want the indicator to look back at for each of the percentage K and percentage D lines. I've seen a quicker percentage K line of 5 periods or 10 periods used in a few stochastic strategies for something faster responding than the traditional 14. And with the percentage D line as an example, traders sometimes look to increase that moving average look back for better smoothing of the line. There's not much point in bringing the percentage D down to 2 periods because it's such a narrow look back, and then 1 period would obviously just sit right up on the percentage K line. Different inputs for these strategy lines will suit different strategies, so if you are committed to using the stochastic oscillator, then backtest a lot of different combinations with a variety of confirmation indicators. There is no shortage of options. You should also get a choice for the method of moving average that you want the indicator to apply. So if you want the percentage D line to not be a simple moving average of the percentage K line, but instead be either an exponential, smooth, or linear weighted moving average, then that is your choice. The exponential and linear weighted averages do give greater weight to more recent data, so should be quicker responders than the simple or smoothed average if that is something that appeals to you. There's the price field selection as well, where you can choose which part of the price you want the indicator to apply to, either the low high or close close. And let's not ignore the input for slowing that's there. That is a setting that can change the speed of the percentage K line. If it's a low setting like 1, the line will respond very quickly to the price changes. I think it would be fair to say too quickly because of all the false signals that it generates. So then the higher the number, the smoother it will be, but obviously don't go too high or it may barely respond at all. Here's an example of two stochastics, both with the default settings, apart from having different slowing inputs. The top one has a slowing of just 1, whereas that bottom one has a slowing of 7. Much less erratic, but it does lag in its response. Whether you want something slower or quicker depends on your particular strategy and maybe your patience as well. So let's get to the signals that we can take from the stochastic, because there are a few. As we said, traditionally this indicator is used for overbought or oversold readings with default levels of above 80 for overbought and below 20 for oversold. And if you picked up any old school trading book on technical analysis, it would unload that mindset onto you. But nowadays, even though it's still advertised with those signals, many modern traders do discredit them. I would wager that if this isn't the first video that you're watching with someone talking about the stochastic oscillator, that whoever you already listened to almost almost certainly trashed the traditional overbought oversold signals or added a million caveats to what you'd need to do to have any joy trying to use them. And in my diminutive opinion, they are not wrong to discredit the overbought oversold signals. Those levels are definitely old hat thought. Whether they worked well in the 1950s, it's possible, but I can tell you it is a very common thought in the 21st century that following these signals in blindly will leave you box shopping under the Brooklyn Bridge with no real hope of any decent future, staring down the barrel of acceptance that the only positive feeling you are ever going to have come over you again is the nostalgia for those golden days of your potential, yearning to just turn back the clock to a time when you didn't go all in on the default overbought oversold signals of the stochastic oscillator. Here's an example where the stochastic first goes into the overbought territory by that yellow arrow there. The trend hasn't even really started yet, and it won't take off for another 10 candles or so before it starts to fly. If you went in at that point, you are unlikely to be making any money without putting out an inane amount of risk and grabbing 1 pip's worth of it. And people will say you don't enter your trade when it goes into the territory, you enter it when it comes back out of the territory. That's when it's telling you that the momentum is burnt out and it's turning around. Oh boy, and how did these sell trades go for us right here? So good, right? And people will say, well, you just cherry pick this chart to show where the indicator doesn't work. And I certainly did cherry pick it. But do you think it took me more than a minute to find a chart like this showing the abject failure of the stochastic indicator? If you do want to play the game like this, then at the very least do try messing with those levels to see if you get anything more effective around the 90-10 or even the 100-0 mark. But it's your money, yo. Another consistently average signal that we can easily visualize on the stochastic oscillator is to enter our trade when the quicker percentage K line crosses over the slower percentage D line. Here we see a few simple crosses where that sea green percentage K crosses the red percentage D line. Here would be our entry points with the buy and sell trades both marked out. But even after all of those particularly smooth entries, that one over there on the far right, that did have a double crossover. And if you were purely taking that cross as a signal, then you'd be losing on a quick sell trade before turning it into a buy entry. So it is fairly common for traders using this signal to only take the signals that occur in the overbought or oversold territory, as demonstrated in all of our yellow ringed entries. Even then though, it is not difficult to find a chart where we see in the overbought and oversold territories multiple crossovers occurring between those K and D lines, jumping you in and out of trades on repeat back and forth. It's a pattern to generate losses. In this price chart example, we can see on the left there is a couple sell signals in there where price actually stays in a range and the lines cross back over before giving you any real chance to take profits. And it's the same over here with those buy trades in the oversold territory. The price trend continues down or just stays in a range. You're going to need a few big winners after that run just to get you back to even. So again, this is appearing quite suboptimal. Moving on with our signals, the stochastic oscillator is one of those that's going to give us some divergence potential. Divergence meaning that the price is telling us one thing, but the indicator is telling us something else. Here's an example of a bullish divergence where the price has recorded a lower low between those two troughs there. However, the stochastic oscillator in the same time frame between those troughs has managed to keep itself off that bottom level and has actually made a higher low. The indication here is that selling momentum has exhausted itself and a reversal is due to the upside, hence being called bullish divergence. And here we see that the reversal does come, and there should be plenty of opportunities for you to take profit in the move. This is the exact opposite in our example here for bearish divergence. We can see that prices continue to push up, making a higher high, but the stochastic oscillator, not convinced by this, so its reading has in fact made a lower high. It's subtle, but you can see how previously the stochastic maxed out, and then on the second peak it's kept off the top, signaling to you that a bearish reversal is proving itself possible. Like any time you're trying to pick out a big reversal, it's difficult to catch them. Far too often it turns out to just be a retracement of the greater trend, or it doesn't retrace for any period of time after you've jumped into the trade. The self-doubt starts coming across you then as you slowly begin to wonder yourself whether you should have just traded with the trend. Well, good news, you can also use the stochastic oscillator in a trend-based fashion. If you are using other trend entry indicators, then the stochastic can prove to be a useful filter for you. You could say, for example, that you'll only enter buy trades when the stochastic reads above 50, indicating bullish momentum, or vice versa, that you'll only take sell trades below 50 where the dominant momentum, according to the indicator, is bearish. Now, that's right, not everything has to be a fancy reversal strategy trying to time the perfect bottom or top. Sometimes all the good stuff is in the middle, like Malcolm, when Malcolm was in the middle. And how about using the stochastic for money management though? Can it help us preserve of capital. Our old trick that we tend to wheel out for these indicators, which we won't make an exception for today, is to reverse some of those entry signals and make them your exit signals, assuming you do plan to exit the trade, that is. If you're shooting for trend trades, your rule could be that you close your trade if momentum moves against you. So say the stochastic is at a reading of 60 and you're in a buy trade, then it falls to a reading of 49, which is of course below the halfway mark. You would then exit that trade because the indicator is telling you dominant pressure now lives on the sell side. Next up, if the percentage line crossed the percentage D line against your trade, that could also act as an exit signal. Imagine again that you're in a buy trade and price then suddenly slips off the tops and the percentage K line drops below the percentage D line. That means you are out of the trade. You close it down because the stochastic is saying that the momentum has shifted against you. Try and keep those profits in your pocket. You could also use those overbought or oversold levels to exit your trade as well. You're back in a buy trade again and momentum is going up and up. The stochastic reading crosses over 80 into the overbought territory. You take the profits there by closing down the trade. You're aware that a reversal could be due as momentum exhausts, so why risk that when you are in the money and have a fair warning signal to get out? I know everybody loves the first step of entering the trade and trying to get in at the best possible time, but the same weight of excitement and enthusiasm should also be given for exiting the trade, and sometimes this is regularly overlooked despite its importance. You enter a trade and sell 5 yourself as price moves a little in your favor, then when it jolts against you in an instant, you face a sudden wave of panic. You start making more bad decisions than a supporting character in a horror movie, and you end up either missing out on profits or straight up taking a loss. Less than ideal. In the markets, you'll find for the traditional overbought and oversold signals, the stochastic is going to work better in a range than an ongoing trend. If price is consistently bouncing up and down, then so too will the stochastic, and if you exit really well, you could be able to catch it going both ways. However, taking repetitive overbought oversold signals in a strong trend with nothing but hope of a reversal is basically a death wish for your account balance, so do try and avoid that. Fortunately, the price of all assets will range sooner or later, so stochastics are going to try their best in any marketplace. Forex, metals, energies, stock indices. Whether they see success over time doesn't necessarily depend on the asset, but on the greater strategy that's being used around the stochastic, and try to make sure to understand what's occurring on the day in the grand scheme of things. There are going to be times like when the market's open or big news drops where the stochastic might be thrown off. We talk regularly about this on here, being prepared for the news so you're not caught entering a trade with your trading pants down. You might think it's smart to trade the Aussie Kiwi, but you don't even realize that it's Anzac Day, so you're not getting the volume or the movement to warrant trading on it. To make an academic reference, I think that we can all take advice from the true Lion King when he says, be prepared. For similar indicators, there are plenty out there to give a turn to. Let's start with the Williams percent range, and I want to show you a quick comparison of the formulas for these two. So here's the percentage K line of the stochastic and the Williams percent range. Anyone seeing these formulas who thinks they are not similar is being willfully ignorant. Both of them are asking the difference between the high, low, and current closing price, then putting that into a bounded oscillator with the default levels for overbought and oversold. So it's no surprise when their signals come out looking like this. The stochastic just showing the percentage K line, but they are incredibly similar to one another, hitting about all the same signals. And there are a lot more momentum indicators out there doing similar things. They've all got some sort of 3-letter initialism going on. The ROC, the RSI, the CCI, all of them with some form of overlap in their signals. So line them up and find the one which you think is the best for you and the market you're trading on. In conclusion, the stochastic oscillator, it is still widely used by traders, but many traders argue against it, particularly with its default settings, so we are getting mixed opinions about the indicator. It is giving you multiple entry and exit signals in the reversal and trend momentum category. Use it for overbought or oversold signals, the 2-line cross, the divergence, the trends. There are options out there, and I think that's one of the reasons that makes this indicator popular and a go-to for new traders is those easy to interpret signals across different dimensions of trading. But are those signals actually any good? Like any indicator that's out there, if if you are using nothing else and expecting to win big or win consistently, well, then the markets are going to second guess you on that, and you can easily do some serious damage to your account. The stochastic has its uses, as we've explained, but they have to be combined with other indicators to help get rid of the bad signals which will inevitably come down on you like a cartoon anvil when you're least suspecting it. Don't let the last words that you hear as a financially solvent person be someone saying that I make loads of money with the default stochastic oscillator settings and signals. Be reasonable with your expectations. And if you're not a fan of the particular methodology of the stochastic oscillator, but you enjoy the type of signals it's giving you, then as we've said, there are multiple indicators out there doing similar things, including the Williams percent range or the relative strength index. Give them a backtest too. That's all from us on the stochastic oscillator, but there is plenty more information and links in the video description if you do want greater knowledge on the indicator. And do consider how every single chart in this video has been specifically pre-selected for showing you how the indicator may or may not work. We have used this indicator though in live forward testing strategies, and those videos will also be linked in the description. Thank you for watching. This is Project Trade. I am the Technical Warlock, and we'll be back for more